Today, Bitcoin and Ether drop amid a broader crypto sell-off. Financial documents reveal BlockFi's billion-dollar tie to FTX and Alameda. And Timothy Cradle of Blockchain Intelligence Group explains why he says banking in crypto will get harder, not easier. Welcome to CNBC's Crypto World. I'm Mackenzie Sigalos. Crypto prices falling as Wall Street faces a morning sell-off. By noon Eastern, Bitcoin dropped about 1.5%, but still traded above the $22,000 level. Ether fell by 4%, trading at around $1,500, and Solana slid 2.8%. Now let's talk about the top stories. First, financial documents for bankrupt crypto firm BlockFi were mistakenly uploaded without redactions, and they reveal a $1.2 billion link to FTX. Just under $416 million in assets were tied to FTX, while BlockFi also had $831 million in loans to Alameda. Now, lawyers for the company previously said BlockFi's loan to Alameda was valued at around $671 million, along with $355 million in assets on FTX, but crypto prices rallied since then. A lawyer for BlockFi confirmed to CNBC that the unredacted filing was uploaded by mistake, but declined to comment further. BlockFi struggled in the wake of 3AC's collapse, but FTX had swooped in to save the firm. But after FTX itself went bust, BlockFi filed for Chapter 11 bankruptcy protection at the end of November. Next, more crypto layoffs to tell you about. This time, the crypto exchange Luno will lose 35% of its staff due to market volatility. The London-based exchange told employees about the cuts during a live-stream town hall today. According to Luno's LinkedIn profile, the company, which has offices in Africa, Southeast Asia, and Europe, has a total headcount of nearly 1,000 employees. That means that more than 330 jobs will be impacted at the exchange, which is a subsidiary of Digital Currency Group. Luno joins a host of other crypto exchanges cutting staff in the months following FTX's collapse. That includes Kraken, Crypto.com, and Coinbase. Just yesterday, we told you that Gemini will reduce its headcount by 10%. Last up, new court filings reveal that crypto miner Core Scientific raised $500 million from Wall Street titans during the crypto boom. According to Bloomberg, BlackRock and Apollo Global Management are among a group of high-profile creditors that lent $500 million in convertible notes. BlackRock acquired $38 million in convertible notes in August, while Apollo snagged more than $33 million in 2022. Core Scientific filed for bankruptcy back on December 21st of last year, blaming low Bitcoin prices and high operating costs. Bloomberg also reports that BlackRock and Apollo contributed millions to let the firm continue operations through those bankruptcy proceedings. All right, on to our main story. Big banks have faced a reckoning with their involvement in crypto thanks to the industry's wave of 2022 scandals. In fact, some, like Metropolitan Bank, say that they're backing out altogether. Timothy Cradle, head of regulatory affairs at Blockchain Intelligence Group, said in a post in LinkedIn that banking in crypto will get harder, not easier. So Crypto World's Jordan Smith spoke to him about how the relationship between banks and crypto will change in 2023.
So I want to start with that post that you had on LinkedIn about Metropolitan Commercial Bank closing down its crypto business. And in that, you said that banking will become harder for crypto, not easier. Can you explain what you meant by that and what some of the issues you see ahead?
Yeah, so what I meant by that and what we're going to see moving forward are banks taking a really hard look at their risk assessments as they relate to crypto businesses. Crypto businesses in the U.S. are money services businesses, so they're already inherently high risk. With the risk warning and the joint statement that the OCC, the FDIC, and the Federal Reserve Board released in December, the effect of that is going to be banks taking an even harder look at their existing crypto businesses. If you couple that with the fallout from FTX, the troubles that Signature and Silvergate are having, and even as recently as this morning, we're seeing Signature Bank now limiting crypto transactions to $100,000, and that's going to begin on February the 1st. The fallout from the OCC risk warning is that that's what banks are going to do. They're going to look at crypto, they're going to look at it with a very sharp lens, and they're going to say, if this doesn't meet our updated risk standards based on what the OCC has asked us to take a look at, they're going to start unbanking crypto and they're going to move away from these relationships. Crypto is already not a very large sector for these banks, so it's not going to be hard for them to walk away from their crypto offerings.
One of the things I think we hear a lot when we're talking about institutional involvement in crypto is regulatory clarity. I think that that's something that both on the crypto side and from traditional Wall Street, they say that that's what they need before they can get more involved. But it sounds like it's purely a risk management move in your mind. Do you think that regulatory clarity, be it from legislation or from SEC involvement and through regulation from enforcement, will help ease some of those concerns from banks?
Well, one thing I would say is there's still a huge need for regulatory clarity. On the banking side, I don't think that issue is the same as it is on the security side or on the commodity side. So when it comes to the CFTC and the SEC, there is a significant need for regulatory clarity. What they should do is follow FinCEN's model and issue guidance on where crypto businesses fit within their existing regulatory frameworks. If I'm not mistaken, Gary Gensler himself said that no new rules or new regulations need to be put into place. And if that's the case, then that means they already have the rules in their toolbox that would allow cryptos to come into scope of those regulatory agencies. So what I have in mind is, again, what FinCEN did in 2019, issue guidance that says crypto companies, your business models and these specific business models fit with our existing rules. And if they don't, then we as a regulator don't have any jurisdiction over what you're doing. From the banking side, they're just looking at this. They're looking at it from two ways. So they're looking at it from a regulatory perspective. What are their regulators going to allow? And they're also looking at it from a risk perspective of, could we possibly lose money dealing with these crypto companies? And we're seeing this very clearly in the case of Silvergate. They're having some pretty significant financial troubles that are threatening the actual life of that institution. So banks have to look at it from both sides. The OCC is not saying right now, we're going to come and take your banking license if you engage with these crypto companies, but they have to be worried that that might be down the road. If the OCC is getting this specific, that they're issuing a warning about interacting with these crypto companies, it may get more severe as the year progresses. And if we don't see other regulators come in with strict guidelines, monitoring regimes, and frankly, just rules of the road for these crypto companies, then the OCC may have no choice but to turn right back around and say, well, banks, we can no longer allow you to provide these banking services to these crypto companies.
Last year, I think we were all waiting for the Biden executive order on crypto regulation, and we were waiting to see how the different departments in the federal government would look to regulate the industry. Do you expect, given what we saw from FTX, what we're seeing from Silvergate, that crypto regulations could be harsher on banks to protect their clients, protect their assets, or do you think that it'll be more of the same and that we might not really get anything for a long time?
I think it'll be a mix of both, because what the regulators can do, where they have power, is on their existing regulated entities. So yes, they can put the squeeze on the banks and say, we may not have clarified that this crypto industry falls under our regulatory purview, but you banks do. So we can tell you not to engage in this activity. So they have that at their disposal. And I would expect that that's what they're going to continue to do, is they're going to continue to interact with the banking side. And they're going to say that, banks, if we can't get crypto under control, we can get you under control. And the banks are going to be worried about that. There's no real good reason for them to stick with crypto unless it's making them a lot of money when they make that risk calculation. So it's going to get a lot harder. The banks are going to be the ones that are going to have their screws tightened on, since they're the ones that are already within the clear regulatory crosshairs, where regulators can already say we have some power here.
At the World Economic Forum in Davos, you saw both Jamie Dimon and Brian Moynihan say that despite their feelings around crypto and some of the struggles there, they're very interested in blockchain technology. Do you see that becoming an important part of the banking system, regardless of regulation? And what does that mean for these businesses that, even though they may be skeptical of crypto, they're still looking at blockchain technology?
I think it's positive for the industry. But if it's the case that you separate the crypto from the blockchain and you have one without the other, it's not very interesting, at least to me, because then it just becomes something that they use on the back end. And it's not that much more interesting than what databases they're using. So for companies that are developing blockchain solutions, that's very positive. But for companies that are developing blockchain solutions that also incorporate a cryptocurrency element, it's still not very positive for them.
What some of the levers the OCC has to pull for crypto regulation and why they might be the one to watch over the SEC or CFTC?
The SEC and the CFT specifically shouldn't have any additional levers that they have to pull. They have their existing laws. All they have to do is do rulemaking on top of those existing laws, and I don't even think that they have to go that far. They really just need to issue guidance and clarify that their rules already apply. The OCC, I don't know why they seem to be in a better position than the SEC and the CFTC to react to crypto. I think it's simply because the intermediaries that the OCC wants to deal with are their existing regulated institutions, namely the banks. So it's not really that difficult for them to intervene and issue things like their risk statement or their risk prospectus, which actually pointed at cryptocurrency as a specific special section. So for the OCC, I think it's easier because they're dealing with existing regulated entities, whereas the other two regulators are dealing with entities that are not necessarily clearly within their purview, though the enforcement actions seem to imply that these are regulated entities under their auspices. They just won't take it that step further, issuing something official in the same way that FinCEN did that says these are definitely regulated entities under our auspices.
Okay, that's all for Crypto World today, but we'll be back again tomorrow, so we'll see you then.